What you are about to hear is not speculation, not a rumor circulating on social media, and not a hypothetical scenario designed to grab attention. What you are watching is the first confirmed sovereign-style failure of 2026, unfolding quietly before most financial markets even opened their doors. While the world was still asleep, a critical chain inside the global commodities system snapped. And the consequences are far larger than a single market or a single country. This is not a drill. It is a documented sequence of events confirmed by logistics firms, port authorities, and internal communications tied directly to international trade flows. As of late December 31st, physical silver shipments destined for COMEX-approved vaults in the United States were denied export clearance at Shanghai ports. Containers already sealed, paperwork approved days earlier, were suddenly stopped. Trucks sat idle, pallets remained locked in place. The metal did not move. Before we go any further, if you value clear analysis, real-world financial mechanics, and explanations that go beyond headlines, take 1 second to like this video and subscribe to the channel. It helps more than you think, and it ensures you don't miss what's coming next. Now let's break down what actually happened. This moment matters because it marks the point where a system built on promises collided with the reality of physical supply. The clock did not start ticking. It already expired. And the response from Beijing made that unmistakably clear. When emergency calls went out looking for negotiation, compromise, or delay, the answer was not silence. It was a firm refusal. No counteroffer. No adjustment, just a closed door. Earlier estimates suggested there were roughly 48 hours before the pressure became unmanageable. That window collapsed almost instantly. Enforcement of new export restrictions on strategic metals began ahead of schedule. Not at midnight, not days later, immediately. And that decision reshaped the opening conditions of the global silver market in a matter of hours.
When COMEX reopens for delivery obligations, it does so facing a problem that cannot be solved with accounting tricks or paper extensions. This is the moment where synthetic pricing structures collide with physical scarcity. For years, silver pricing has been dominated by leverage, derivatives, and settlement mechanisms that assume metal can always be sourced somewhere at some price when needed. That assumption is now broken. Over the last 12 hours before the cutoff, while most people were focused on year-end celebrations, a very different scene was unfolding at altitude. Flight data shows a private jet departing New York, bound for Hong Kong, with a passenger list deliberately obscured. According to multiple independent sources familiar with the situation, that aircraft was not carrying tourists or executives on holiday. It carried senior figures tied to U.S. commodity desks, regulatory oversight, and central banking infrastructure. Ask yourself why a regional Federal Reserve official would be involved in what appears, on paper, to be a private commodities issue. The answer is simple. This was never about a single metal trade. It was about systemic exposure. Silver flows through collateral chains, margin structures, and derivative agreements that connect directly into the core of the banking system. When that flow stops, the impact travels fast. The jet landed in Asia early the following morning. Within hours, meetings were underway behind closed doors. No cameras, no press releases, just a proposal placed on the table. The offer was direct, an emergency acquisition of tens of millions of ounces of silver, cleared for immediate export, structured to avoid traditional dollar settlement channels. treasury instruments, bilateral swaps, and legal carve-outs were used to construct a path around existing restrictions. On paper, it was clever. In reality, it was desperation. And the response came quickly.
After a brief review, Chinese officials returned with a single-word response. Not a negotiation, not a delay, not a price adjustment, a refusal. The meeting ended shortly after. By the afternoon, port authorities began stamping outbound shipments with regulatory blocks. Export clearance denied. Containers already cleared days earlier were reclassified under new enforcement rules. This was not a warning shot. It was execution. Logistics firms that specialize in bullion transport independently confirmed the same outcome. Identical language, identical red markings, identical instructions. Shipments bound for U.S. vaults were frozen in place pending compliance review. That phrase is not ambiguous. It means the restrictions are active, not theoretical. At this point, it is critical to be precise about what this means. Behind the scenes, a quiet attempt was made to source physical silver to prevent a delivery failure. That attempt failed. The refusal was not about price. It was about control. Physical resources were not going to be sacrificed to stabilize a foreign paper market. This is the line where the conversation shifts. Because once a supplier of last resort declines to participate, the entire pricing mechanism becomes unstable. Markets that rely on confidence and rollover assumptions suddenly face hard constraints. And those constraints do not negotiate. When mainstream coverage eventually arrives, it will be softened. It will be framed as trade friction, regulatory tightening, or routine enforcement. What will not be emphasized is why regulators, central bank officials, and commodity traders were sitting in the same room, trying to prevent a single outcome. Forced recognition that the metal backing the contracts was no longer available. Now let's look at what the numbers actually say. As the delivery window opened, roughly 12,000 futures contracts were standing for physical settlement. Each contract represents 5,000 ounces. That is 60 million ounces of silver promised for delivery over a short time frame. Registered inventory showed approximately 41 million ounces listed as available. On the surface, that already implied a gap. But here's the part rarely discussed. A significant portion of that inventory was not physically present in domestic vaults. It was in transit, scheduled to arrive in early January, refined overseas, loaded through Asian ports. Those are the shipments that never arrived. When you strip out metal that exists only on shipping manifests, the true deliverable supply drops dramatically. What remains is closer to 18 million ounces, against 60 million owed. That leaves a shortfall approaching 70%. In any transparent market, that imbalance would force price discovery upward until supply met demand. Sellers would demand higher prices. Buyers would compete. Metal would move. But this market does not function that way. It is governed by rulebooks, margin adjustments, and settlement clauses designed to prevent exactly that outcome. And that response came swiftly. Buried deep inside an exchange advisory released late at night was a critical clause. In the event physical delivery cannot be reasonably completed due to circumstances beyond the exchange's control, settlement may be forced in cash at prevailing futures prices without penalty to the short position. Translated plainly, if the metal isn't there, the promise changes. The obligation becomes a check, not a bar. And the party that failed to deliver walks away without consequence. That is not market discipline. That is rule modification under pressure. And the timing matters. This advisory was released when almost no one was watching. It was not designed for retail traders or long-term investors. It was a signal sent to institutions that needed reassurance before markets reopened. For anyone still holding contracts expecting delivery, the implication is severe. Settlement would occur at a price far below the real-world cost of sourcing metal. While futures hovered around the low 30s per ounce, physical silver in Asian markets was trading dramatically higher. The spread was not incremental. It was structural. This is where losses crystallize. If you sold a contract at 30, expecting to source metal later at a small premium, and the real cost suddenly becomes 90, the math breaks instantly. Multiply that gap across tens of millions of ounces, and losses move from manageable to systemic. And that is only the visible portion. The deeper exposure sits in over-the-counter derivatives, structured products, and hedging agreements tied to that same benchmark. When physical settlement fails, counterparties do not simply accept a cash substitute. They enforce clauses. They demand coverage. They call collateral. This is how localized stress becomes systemic pressure. And it explains why, at the same time this was unfolding, liquidity operations surged quietly in the background. Overnight funding injections spiked dramatically. What is usually a routine year-end operation expanded several-fold in a matter of days. That does not happen without cause. Banks seek overnight funding when they face immediate collateral constraints. When those needs spike suddenly, it signals strain that cannot be deferred. Silver is not a fringe asset in this context. It sits behind hundreds of billions in notional exposure. It is pledged, rehypothecated, and referenced across balance sheets. When its availability is questioned, the effect ripples outward. The chain is straightforward. Futures contracts reference benchmarks. Benchmarks anchor derivatives. Derivatives support collateral structures. Collateral supports lending. Break one link and pressure propagates fast. As long as physical supply can be sourced quietly, the system absorbs stress. Once supply is withheld, stress accumulates. That is what changed here. The refusal to export metal was not symbolic. It was mechanical. It removed the release valve. From this point forward, the gap between paper pricing and physical reality is no longer theoretical. It becomes visible in spreads, in forced settlements, and in emergency policy responses. That gap does not close easily once exposed. This is why the language surrounding this event matters. It will not be labeled a default. It will not be described as failure. It will be framed as adjustment, optimization, temporary measures. But contracts promising metal that cannot be delivered are still broken promises, regardless of how they are renamed. What you are witnessing is a modern form of default, one that occurs not through missed payments, but through altered obligations. And once that line is crossed, trust erodes quickly. From here, every participant recalculates risk. Every counterparty reassesses exposure. And every promise tied to physical delivery is viewed through a new lens, not as a certainty, but as a conditional offer subject to revision when pressure rises.